everyone, this is Demo Gonzalez of Heartwood Financial Services. Thank you for joining us for our latest market update and outlook video. I know it's not quite as exciting as NFL football, but if you're watching the Dolphins, it's definitely better than that. So anyways, there's been a lot of noise, a lot of things going on in the media about what's been going on in the economy, but I want to give you what's really happening, just showing you the numbers. And then I also want to talk to you about a couple ideas for the outlook. One as a cautionary thing to look out for, and another one something to look forward to. And as always, you'll get my implications for you and your portfolio. So let's get started. Alright, first let's get started with the asset class returns for the month of August. And we've been on a nice little run here. This is 4 straight months of positive returns for the stock market in the U.S. And what we're starting to see now, which we haven't really seen in the past, is a little bit of a broadening out of the market. That usually happens as things start to look better for the economy, not worse, which is interesting. We'll talk more about that here in the update. But as we look here, what I mean by the breadth is small cap stocks are up 7% for the month of August. That was the leader in all the marketplace. The S&P 500 was up about 2%. Real estate did pretty good too, a little bit better than large cap stocks, but as you can see, mostly led by small caps. International continues to do well. In fact, they had a nice little resurgence. Last month wasn't as good, but August had a nice little comeback, especially for developed international. The dollar's been weakening. You've probably heard the Fed talking about how they might be lowering interest rates. And with what we saw on Friday, I'm recording this on Monday, of the jobless numbers. We're going to get more into that. It showed the dollar weakening a little bit more. So that's been very good for international. Also good for fixed income with rates potentially going down, high yield commodities, basically everything. Yields going down is usually good for asset prices. So we're seeing that reflected here. So let's get more into what's going on with the economy and what's to come. All right, here we go, talking about inflation again. It just won't go away, and it's a very important topic. So real quick, we had the PCE numbers that just came out last week. The numbers were a little hot. So you can see here the headline number, that's the number that includes everything, was up 0.2 month over month, not month, but month over month, and 2.6% year over year. So it's a little hotter than what we want it to be. We want to get it closer to 2%, so it's still a little hot. And when we take out the energy and food, which is what we call the core PCE, it was actually even a little hotter, 0.3 month over month, 2.9% year over year. So going the wrong direction, but not in a very fast way. And when we look at all the underlying numbers, it's mostly the goods inflation that has been going up. So you can say that the tariffs are starting to have a little bit of an impact here. Is it enough of an impact to make the Fed hesitate on cutting rates? At this point, it doesn't look like it. We'll get more into that here in just a minute. All right, let's take a look to see how the economy is doing. I call this the Big Three report. I use these economic indicators that are kind of more leading economic indicators, except for this BLS report. But the ISM manufacturing and service numbers are very important numbers for the economy. It shows how the manufacturing part of the economy is doing. We want to see the numbers above 50, so the manufacturing number is still a little bit below 50, but it's been below 50 for well over a year now, and the market's done okay. So it just goes to show you the manufacturing part of our economy is not as big, not as important, but hopefully, growing. We'll see. But it was a 48.7, so it was up from the previous month at 48. So that's a nice positive trend there. On the services PMI, that again is the more important number. That's 70% of our economy. It went from 50.1, which was barely positive above that 50 number, to 52. This is a very nice number, a good upside trend that we're seeing in the services. So that kind of bucks some of the other trends that we've seen, and including the employment report that just came out on Friday, just a few days ago. I'm recording this on Monday, where we had a very disappointing employment number at 22,000 for the month of August, and the unemployment ticked up a little bit to 4.3. We had 73 last month for employment and a 4.2. Now that's still a positive number for employment, so I'm going to put that on the upside trend, but it's pretty weak as far as that trend goes. So that's where we're starting to see a little softness in the economy. So that's not great, but it's not a sign that things are unraveling or anything like that, especially in context to the ISM Services PMI. All right, so what is the Fed going to do? Well, they're going to get together on September 17th. Actually, they started on the 16th, and the 17th is when they make their announcement. The Fed indicated that they're very likely to be cutting rates. Now, they didn't outright say they were going to do it, but they really hinted pretty strongly, I felt, that they're going to probably be cutting rates. And so you might ask yourself, how can the Fed be cutting rates when you see that inflation has been sticky and maybe actually going up a little bit? Well, a lot of it is because that unemployment report, as I showed you a moment ago, started to show some weakness. And remember, the Fed has two mandates. It's keeping price stability or inflation, and also keeping unemployment at a good place. So when they're seeing one part of their mandate kind of weaken a little bit, they sometimes sacrifice one side of the mandate to protect the other side of the mandate, and they're seeing that unemployment is maybe a bigger risk right now. And I tend to agree with that. I think we're starting to see some weakness there. So the probabilities of a cut now are 95. In fact, I put together this slide on Thursday. It's probably even higher than that now that we had that jobs report on Friday. And so, in fact, the market is even starting to anticipate that there's a probability of a 50 basis point cut. Not sure that's going to happen, but we're basically seeing that the Fed is going to most likely be cutting rates here unless something really crazy happens here in the next couple weeks. All right, so in the outlook, I wanted to talk a little bit about the September effect. I would be remiss if I didn't talk about this. I rarely do, but it is something to be aware of. September tends to be one of the worst, actually, I should say, the worst month of the year when you look at the calendar. Every other month is positive. This one historically has been a little bit negative. This is looking here at the last 50 years. You can see that the S&P has been slightly negative. There's a lot of different reasons for that. We're talking about rebalancing, people coming back from summer vacations. We get third quarter earnings reports that usually guide down a little bit because, going into the holidays, they want to be a little conservative. And so there's a lot of different reasons for that. But it doesn't always happen that way either. We've had last couple of years have been pretty good September. So it's never a for sure thing. But it's just something to be aware of because I do have a little bit of a cautionary feeling with September and in this particular one here for these other reasons as well. So tariff uncertainty continues and it's ramping up a little bit. In fact, you may have seen the appellate court that ruled that a lot of the tariffs that Trump's using were unconstitutional. So maybe some of that has to be paid back. Now, of course, that's going to the Supreme Court, and there's some other things that I think the administration can do to keep the tariffs. So that might be more noise. But it's definitely something that is to, upsetting the markets a little bit. And then we have the high average valuations. The S&P 500 is trading at about 22, 23 times earnings, where it's normally closer to 19, 20. So it's a little expensive. Now, all the AI hype has definitely made a difference there, and there's probably some real validity to that. But it's still, nonetheless, it's something to keep an eye on because the market is not cheap. And then, of course, we've seen what's been going on with the Fed, the board, and Trump firing, one of the Fed governors, and now they're fighting it. And so all this stuff has been in the news, and it just kind of builds a little bit of uncertainty and anxiety. So something to keep an eye on for the month of September. All right, and the last chart I want to show you here in the outlook is top producing countries, power producing countries. And this goes back about 40 years or so, but this was really interesting. I was reading an article that was showing this visual capitalist chart, and it just blew my mind. Look at how much more energy and power is being produced in China. They're producing more power than almost the whole world here combined. And so when you're producing more power, you got more potential in your economy, but also in your military. And so I think it's very important for the U.S. to ramp up their energy production to try to keep up with China, because it's an economic race and it's a military race. And so there's two huge themes that I think are going on here that also merit for not just for the U.S., but for the whole world to increase their energy production capacity. One is that we're trying to reshore more things here in the U.S. and more friendly countries to the U.S. And with that, we're going to have to produce a lot more energy. It takes a lot of energy to make ships and airplanes and cars and things like that here in the U.S. So we're going to need more energy production for manufacturing. But also, number two would be for AI, artificial intelligence. These data centers and supercomputers, they take a ton of energy to run and to cool. And so we need more energy production so that we can keep up, just to keep up. So we keep up with all the energy needs of this AI race, which is a huge part of our economy, but again, also for the military. And so who's going to benefit from this? It's going to be all the companies that provide energy, the companies that transport the energy, that support the grids, and all the infrastructure behind our energy. So it's going to be very important, to invest in those areas. I think it's going to be something that is going to be a good growth driver, not just in the short term, but for some time here to come. So you'll see my implications where I'm starting to do some tweaks. You may have noticed that in your portfolios. And part of the reason is behind this big secular trend that we're seeing here. All right, and so the Heartwood implications are we're staying pretty neutral right now. We're seeing the economy still holding pretty steady. Don't see a recession in the near term, but it does appear that the labor market is starting to soften a little bit. That's going to slow the economy down a little bit, but hopefully what we're going to see is that this is just a little soft patch and things are going to recover going into 2026 as we see some of the stimulus from the One Big Beautiful Bill and some of the deregulation and some other things start to trickle into the economy. And so what we're doing here is, again, we're reducing long-term bonds, adding to the more economically sensitive floating rate bonds that pay a much higher yield. Also adding a little bit of that into income-producing large cap stocks, kind of like some of the stocks we were talking about a moment ago in the previous slide, looking at that long-term trend in utilities and energy and things like that. No changes in gold and commodities or anything like that. We're not ready yet to go heavier into commodities. That's usually more when the economy is really starting to grow and to come out of a doldrum of some sort. And also the mid cap, small caps kind of staying right around where we were there, not adding to that yet. Don't like to go into small caps with the economy slowing down. We want to see the economy start to pick up again. Of course, the Fed lowering rates is going to help that, but I need to see more economic strength before we go there. So for right now, that's where we are. If you guys have any questions, please feel free to reach out. If you know anybody that would find this helpful, feel free to share that with them, and I'd be happy to answer any other questions or concerns that you have. But thanks a lot for watching. God bless.